Welcome everyone to today's CSIA partner webinar, a discussion of PPP versus EIDL. My name is Colin Hammond and I will be your host today. For those of you who are unfamiliar with CSIA, we are a global nonprofit professional association with over 500 member companies in 40 countries. Our mission is to advance the practice of control system integration to benefit our members and their clients. Our vision is to ensure that manufacturing and process industries everywhere have access to low-risk, safe, and successful application of automation technology. CSIA membership offers members access to resources needed to attain and exceed business goals. To highlight just a few of our many member benefits, the CSIA Best Practices Manual guides control system integration companies in the setup and running of a solid company. CSIA Business Insurance Program offers members an excellent insurance program for business owners, subcontractors, and more. The program includes members from all over the world enjoying the peace of mind that comes with CSIA insurance. Clients in all industries are now seeking integrators with a CSIA certification alongside ISO. They recognize CSIA certified integrators' commitment to industry standards and business acumen. As a result, being certified can shorten the sales cycle as well. CSIA Industrial Automation Exchange is the premier automation guide featuring system integrators and suppliers who provide industrial, manufacturing, and process automation solutions. For integrators and suppliers, it's a place to market their expertise. Clients will find white papers, case studies, capabilities, contact information, and engage in conversation directly with CSIA members. And also, please follow CSIA's online events calendar for all upcoming webinars, including both partner webinars and business webinars. CSIA's business webinars features topics handpicked by CSIA leadership to help you run your business. CSIA's partner webinars are opportunities given to CSIA industry partners to address hot topics and demonstrate their expertise. And for more information about CSIA, please visit our website or contact us at info@staff.controlsys or 847-686-2245. And at this time, I would like to introduce our presenters. Timothy Finerty. As an owner of the firm, Tim provides high-level tax, accounting, and consulting services to business owners of domestic and foreign-owned subsidiaries. He is particularly attuned to the needs of manufacturing, distribution, and system integrators industries. Tim has been an advisor since 2001 and collaborates with clients to help reduce their tax burden, make their global expansion seamless, and reduce the amount of time spent on their financial analysts and KPIs by utilizing the firm's internal and external network of experts. Brian Parzak. Brian is a manager within the firm's system integrators team, joining Clayton and McKervy in 2011 after a dozen years working as a mechanical engineer. He uses background in systems and processes on a regular basis to support the needs of the manufacturing and system integration industry, including project management for research and experimentation, tax credits, and accounting services for domestic and international clients. Known for making complex issues easy for clients to understand, Brian is skilled at anticipating and addressing the needs of business owners during the startup phase and beyond, allowing them to focus on what they do best. And with that, I will now turn it over to our distinguished presenters. Welcome, Tim and Brian.
Thank you. Thank you so much. Well, I guess this is a hot topic. Everybody's talking about it. So we're going to talk a little bit about the CARES Act today and the key considerations. So just to start a high-level agenda, we're gonna kind of get into the details a little bit of the CARES Act. And I think, as Colin mentioned, the big thing is the PPP, or the Payroll Protection Program, versus or what you can do with the EIDL, or the disaster loan. We're also going to talk a little bit about some other items that are in there, but I think most of the CIA members that are registered for this and kind of looking at it, and the majority of the members are under the 500 employees. So we're going to kind of focus on the differences and the opportunities between those two. We'll also kind of talk about some additional things, because we're still running a business and really trying to understand what other things should we know. So kind of what the big picture things to consider now are, looking at cash management, and maybe even some tax planning ideas to help stimulate some additional opportunities as well as some additional cash. And then maybe a little bit on retirement and succession planning if we have time. So we'll kind of get started, but just to let you know, if you guys have questions, please feel free to use the Q&A questions. Brian and I will be taking those as we go through this, depending on kind of some of the key areas that we need to talk about. So let's kind of get started and go from there. So the Stimulus Act, or the top options that are there, is the Paycheck Protection Program, which we talked about, the Economic Injury Disaster Loan that we mentioned, and then for the bigger clients, potentially, you got the Payroll Tax Deferral and the Employee Retention Credit. The other one on here is the Loan Payment Subsidy for companies with certain SBA financing. So I'll touch on that one briefly before we get into the bigger details. So if anybody currently has any sort of SBA 7A or 504, and sometimes a lot of companies in the small to medium-sized businesses have some real estate that they may have bought using the 504 program. If you're not aware of it right now, basically what's happening is coming up with after 30 days, after the first payment your last payment really. So if you made a payment in April, your May payment is going to start where you no longer have to make the payment. The SBA is going to pay principal and interest on those SBA loans for 6 months. And so what basically that means, it's not a deferment, it's a payment. So it's going to reduce the total amount that you have to pay and the principal portion of that loan, as well as the interest. So as we move through the Paycheck Protection Program, there was some new guidance that was issued as of 3/31. Again, it still is anticipated not more than 25% will be forgiven amount for non-payroll costs, and we'll kind of get into that in a little bit. It doesn't include costs for independent contractors, as far as we can see. And the interesting stuff still is that we're still hearing from the banks that there is still not anything conclusive in what we're thinking. So hopefully there'll be some guidance, some additional guidance by the SBA here within this week. I know that we've gotten different, our clients are using a variety of different banks, and each of the banks are still asking for different information. I think they're trying to gather as much as they can so that we know what is out there. The terms still indicate that it's going to be a 2-year term at 1% interest rate that's fixed, and that could end up being longer than that, meaning if you can't pay it within that term, 2-year term, you may be able to ask for additional amounts, and the interest rate could go up. This was one of the changes that happened as of 3/31, is the interest rate went from 0.5% to 1% annual. The interest does accrue at the time of the loan, but the payments are deferred for up to 6 months. The sample application available is here. I think most people probably have already started it. If not, this is where you can find it. You do have to go through a bank rather than the SBA direct for the Paycheck Protection Program. So if you don't have a line of credit or don't have a bank or a person that you are dealing with, you have to somehow go into that branch or at least talk with them or set up some sort of account with a bank that would be providing this. So that's kind of where it starts. So who can apply? I think we already established, I think most people know that anybody under 500 employees can apply. There are certain exceptions to that threshold, especially if you're in the restaurant business. But you know, people here in CSIA, if they have companies that they own or other things, there's other exceptions. But you have to have employees on February 15th, 2020. There is loan forgiveness available, and we'll kind of go through that in a little bit more detail shortly. And then the maximum loan value is the lesser of 2.5 times average monthly payroll, or $10 million. And right now we're seeing that a lot of it's based off of 2019, but recently, or this weekend, I had a few banks come back and ask for kind of through February and potentially through March. So I think this is where there's still some questions out there that we're really unsure of. So what can the program be used for? It can be used for payroll costs, rents, utilities, interest obligations on mortgages, and interest on other debt obligations. That's kind of what they've defined it right now. We expect that's, you know, we don't expect anything new on that, but that's what we think. So let's go to payroll cost, right? And again, this is something that, and I was even watching this morning on some news channels where they were talking to people of Congress about this, and there's still no known exact fact of what is, but in theory, these are the things that would be included. Payroll costs include, you know, your salary, which is, you know, wages, commission, or similar compensation. If you had, you know, tips or other things, those would be included. Even allowances for dismissal or separation of employees. So if you had employees that you had let go, but you had severance packages, they would be included, you know, up to that 100,000. Then you also have payment on healthcare benefits and retirement benefits, as well as payments related to state payroll expenses. And our interpretation on the payroll expenses for state and local are really kind of your unemployment costs. But, you know, again, we don't want to be missing anything. So I think talking with your bank on what they're including in these is very important. I think the portion that they say payroll costs don't include is anything over the $100,000, employees not in the U.S., and any credits that you may have already received under the Family First coronavirus, which was the sick leave. So there's the potential that you're getting some credits against that if certain people qualified for that sick leave program, as well as right now the employer portion of the FICA and Medicare taxes, they say do not include. All right, so on the loan forgiveness, it's limited to the principal amount borrowed. It may not exceed the amount spent by the borrower during the 8-week period after the loan origination date. And the loan origination date is an interesting thing as well. So we have been hearing some different things here as well, is that everyone's kind of putting in for approval right now to make sure that they are able to get these funds. There has been a couple conversations I've had with different bankers that they've heard potentially you can get approval and the date of the loan can be sometime before that 8-week period ends June 30th, 2020. And that's where it's saying right now is that 8-week period would end June 30th, 2020. So you would need to make sure you take the funds potentially like May 4th would be kind of starting that 8-week period. We're not sure of that one yet. So, hopefully we'll continue to get more guidance during this week and can kind of go from there. But you cannot, it has to be offset against, that payroll cost, the mortgage interest, the rents and utilities. And you can only use 25% of that cost for non-payroll costs. So if you didn't use it, if your mortgage interest, your rents, utilities didn't cover 25% of that loan, you would just have to repay that additional loan over that period of time. So, and then the other thing on the loan forgiveness is they're still looking at, and I heard something today as well. So for example, if you get compensation for an employee for $10,000, but then the employee puts $2,000 in for federal taxes, you're potentially not going to get that difference between 10 and 2, which would be, you would not get the $2,000 forgiven. You get $8,000 forgiven. So the remaining portion would potentially be having to be paid back, because the government would be getting that $2,000 from the employee, not from the company.
Hey, Tim, we had a question come in here. In calculating the eligible loan amount, you mentioned that the PPP does not include the independent contractors, but will the independent contractors themselves be able to then apply for a PPP loan?
That is how we're interpreting it, of what the legislation basically says, is that those independent contractors themselves, being either a sole proprietor or a company themselves that pay those independent contractors that you're doing the work for, that company would apply for it. The independent contractors and the sole proprietors by themselves apply starting this Friday, I believe April 9th, is when they apply for it, and follow the same rules as the small businesses. All right. So again, on the loan forgiveness, it's going to be potentially, if you spend it all, depending on how you spent it, there could be still some reduction if you had a reduction in employees retained. So for example, if at the time you got the loan, you had an average employees of 50, and at the time you finished up the 8-week period, you had employees of 45, you would potentially get 90% of that loan forgiven. It also can't be reduced by any more than the 25% we talked about as well. So I think, those are the kind of the key things that you have to think about with respect to the loan forgiveness. Here again is some open questions that we still are somewhat not been completely answered. The one related to origination on cash or accrual basis, we believe it is cash basis because they're doing it off of payroll records that you put in with the 941s and the 940s. The fringe benefits, there's still some open questions there. And there still is some open questions on affiliated group rules. I'm not sure that this group has any major issues with that. But if you do have, if any of the people on the call have a U.S. subsidiary and they are foreign owned, there could be some affiliation rule issues.
Hey, Tim, we've had a couple other things come in. One was I think more of just a comment from one of the attendees that their payroll service provider has created a special report for use as part of the applications. And I think probably the only thing we would caution there is that from what we've seen, the payroll service providers are kind of in the same position that the bankers are, and that each company kind of has their own interpretation of what's qualifying and what isn't qualifying. And so if the IRS comes out with, additional clarification like we were talking about, you'll just want to verify that those numbers make sense and that they did capture everything that was supposed to be captured when submitting your application. And then the next question, Tim, is if you have to let an employee go due to zero tolerance issues, for example, drug use, can you replace that employee to keep your eligibility for loan forgiveness?
Yes, it doesn't have to be the same employee. So, I mean, that's the key thing too. And that's, I think, when we start getting into, what are you doing? If there is an opportunity that you wanted to get rid of certain employees because they still weren't doing what they should be doing, you can lay them off. A lot of times those employees potentially would get a decent amount of unemployment, but you can definitely hire new employees that then would offset that old employee. So yes to that answer. And just to also add to Brian's previous comment related to payroll companies, I mean, we definitely, we see ADP's report being different than Paycheck's report, potentially being different than others. So it is crazy that we can't get exact numbers on some of this stuff, but I think when we've been doing some of our analysis with some clients, when I look at a 12-month calendar year and a rolling 12 months and adding in a few different taxes here and there, it's not a significant, in most of my cases, has not been as significant. For example, I have one client getting about a $500,000 loan. And when we changed it from 12 months to, the calendar year 12 months to a rolling 12 month, it was a total with the 2.5 times of $9,000. So if your payroll is fairly consistent on some of these things, you're not going to have much swings. The biggest one is going to be potentially, whether or not they exclude or include employer portion of FICA tax that could have a significant amount on it, depending. I mean, if you think about it, if you had $1 million of payroll, I'm just going to use $1 million, you would have potentially $62,000 of FICA taxes that could get added. But if you take 1/12 of that, that's less than $6,000 as an average, right? So, I think the main point of what's going to add the most value to this is the payroll cost, which is what I think most people have gotten a decent understanding of. Any other questions, Brian, right now?
Yeah, actually a bit more tactical, on the application, things like that. But can you give a little more detail on calculating the employees who make more than $100,000 per year, how that's factored into it?
Yeah, so the way that we're looking at it is only reducing compensation, so gross wages. So if somebody made $150,000, and then had health benefits and retirement benefits, we're only reducing $50,000 out of the compensation calculation. And that appears to be how that form is working, because the health benefits and the retirement benefits are kind of on a gross basis. So there is some, at least it looks like, some advantage of, if you made some larger profit sharings, or if you paid, you had a decent amount of health benefits, that could add to the total amount that you're getting.
Okay. What about, are you making any recommendations to your clients on how to kind of track that this money was spent for qualifying purposes, like setting up a separate bank account, or just kind of keep everything in the same account and then just track everything in your accounting system?
Yeah, I mean, I think it's dependent on how complex your operations are. If your operations are more complex, it may make some sense to kind of isolate some of this cost. I think we're making the recommendations to somewhat capture all these costs just to kind of have a better understanding of if, once you get back to normal, what was normal and what was unnormal? What was the total amount of expenses or your burn rate that you had because of all these, because you weren't able to produce parts or you weren't able to do X or Y. That's kind of what we're kind of looking at, because I think it gives you a better understanding too, as we get into some of the other key tax tactics of what it is that you should be managing your business off of going forward.
And how about for going back to the employee counts in order to qualify for the forgiveness? What periods are they comparing the counts against? Is it the difference from your head count at 12/31/19 versus the end of the 8-week period, or is it from loan origination date to the end of the 8-week period?
Yeah, that one, again, I'm not sure we know. It's going to be, my guess is it's going to be based off of how the loan was given. So if it is given off of the calendar year, so then it would take your average number of employees at the end of 12/31/19 and compare it to the employees that you had at the end of the 8-week period.
Okay. Another question related to the forgiveness opportunity, and I think that this is something that just the business owners will be asked to certify during the application process. But have you seen or heard anything about requiring proof of economic hardship or impact in order to qualify for the forgiveness?
On the PPP, we are not seeing that right now. So everything that we read, there's nothing that has to show up that there was economic hardship. I think it's just they're trying. When you think about it, the way that it somewhat works is during that period of time that you're keeping your employees on, the government's not having to pay unemployment. So it's kind of thinking about it as if you're just keeping them, and then they're trying to incentivize you to keep them happy, so they're not going somewhere else after they're collecting unemployment, or if they can find they want to go into a different field or whatever. So that's kind of why I don't think there's anything related to the financial hardship. What they're trying to do is keep a cohesive unit rather than having to lay people off.
Okay.
All right. So we talked already a little bit about the subsidy, which I think is a really good opportunity, making sure that you are taking advantage of it. I believe it's an automatic, so I'm not sure that you have to do anything, but you should just talk with your bank on this one. So the next one on the economic injury disaster loan. So this one, the last question was, do you have to show any hardship? This one, you definitely have to show some hardship. And our understanding is that you can apply for this loan as well as the PPP. You cannot use this loan, though, for the same things that you used it for the PPP. So, for example, this one would be used on kind of more working capital type stuff. For example, I know in this industry, there's a lot of stuff that's done on a percentage of completion basis. And with new projects that might come aboard right after this thing, people may say, I'm not going to pay you for 180 days, or I'm not going to pay you until it's 90% complete. So from a working capital standpoint, you're not going to be able to come up with the money at that point in time. So this loan, potentially, if you can show that it's going to cause some problems, what it basically could do is, if you had, just for example, if you had a $2 million line of credit right now and you weren't getting paid on your receivables and you had some unbilled receivables, you know, you might be able to take that 2 million and term it out, right? So then it would free up your line of credit to start over with and be within its, you know, whatever standards that you have on your covenants or other things like that. You probably will have to talk to the bank about this, make sure that covenants are issued. But here's an opportunity that you could take a $2 million loan, term it out over 30 years, and pay at a fixed interest rate of 3.75%. So, you know, it could be a really good opportunity to make sure that you have some working capital needs. Now, there are some things related to it. It still is all the size requirements. It's 500 people and below. There are some personal guarantees on this, and there are some collateral requirements. So this one, where you don't have to show credit worthiness, or the PPP, you didn't have to show credit worthiness. This one, you're going to have to show some of that stuff. You're going to have to prepare more documents. But I think it is an opportunity, if you're really looking at and you've kind of seen what's happening with your business, that you could get some very low long-term borrowing to help you sustain and potentially grow. A couple things on this, right? Personal guarantees would be waived if it's under 200,000. So if you're a much smaller business, this could make some sense to really, if you haven't had the chance to do or don't have a line of credit, this might be an opportunity for you to get a $200,000 line that wouldn't be, you know, that would be termed out, and that would give you a little bit of cash to kind of grow your business maybe. You had to be in business for 1 year before the disaster. And before you had to be in 1 year, but now you only have to be in business since January 31st. And the applicant is unable to obtain credit elsewhere. So meaning that your current bank isn't going to extend your line of credit, right, or give you more ability. You may be able to apply for this, and they would allow it, because most of the time the SBA still is guaranteeing a majority of this. And we talked about how you can use it for both. So, all right. So the next couple, I'm not sure I'm going to touch on very much. These are mostly, if you're not taking advantage of the PPP, there's a couple extra things here. So if there are if there are both on the payroll tax deferral or employee credit, anybody that needs more information, these slides will be available, and then if you need to, you can reach out and look at that. All right. So, Brian, any additional questions before we move on to some other stuff?
Yeah, another one just came in here. Basically saying, you know, and I think this is probably, you know, the person who put this question in probably is the only one having this. We've seen it within our client base too, that they're having a difficult time applying for the PPP loan. The application, in the case of their bank, the application wasn't available until Saturday night, and it was only open to companies owned by a single person, et cetera. And the question was, do other clients have the same situation? Do you think having to wait to apply is going to put us at a serious disadvantage? Is it a first come, first serve program?
Yeah, so we're still seeing a few banks in our area that haven't gone live. And I think some of those banks have decided they didn't want to go live because they want to get the right information into the system. So they only have to apply once. Our understanding is a lot of people that have applied, it's applied through the bank, but the bank has not submitted those forms, or most of them, to the SBA yet. regarding the first come, first served basis, that is kind of what they're saying. However, I continue to hear that if the funds run out, they're going to apply more funds. I mean, effectively, they understand that a lot of the small businesses are the ones that are not as sophisticated, and it may take them longer to get this information into the system rather than some of the, let's say, 200 to 500 employee companies that might have a sophisticated accounting office or department and can get this stuff done rather quickly. So I cross my fingers and think that the money won't run out, but we do need to, based off of what they're saying right now, we do need to get that money potentially by May 4th so that we have an 8-week period before June 30th ends. However, they did say that that could get extended as well. All right, moving on to kind of some of the business provisions that they added in, which really could have some great opportunities for some of the CSIA companies. So the first one, the net operating losses. So in the 2017 Tax Act, they limited net operating losses in 2018 to 500,000, and then you couldn't carry it back. You'd have to carry forward losses. They got rid of that, and you now can carry back losses to 5 years. And remember, a lot of people, I know a lot of my clients that were under 25 million in gross receipts were able to change to cash basis. And that one-time cash basis change, and even if you didn't do it in 18, you could still do it in 19, could cause a large loss on a tax basis. And that if you have basis in the company, that loss could then be carried back to previous years to potentially offset, taxes that you may have paid 5 years back. So I know that a lot of companies in CSIA also take advantage of the research and development credit. And there were some changes in 2016 that helped the R&D tax credit community. But before that, you were limited on the amount of credits you could take. Therefore, you may have paid taxes, say back in 13 or 14, and now with 2018, you potentially can carry it back 5 years and offset some gains back then. So it really is an opportunity to kind of look at it. There's more time on this, so I would focus on the PPP first, but then looking at some of this stuff and seeing if there is opportunities to do that. There was some limitation on business interest for companies that had over 25 million based off of debt and some other stuff, but that has gone away or has changed a little bit. So you may be able to use some of that. And one of the biggest ones that we've seen for some of our clients is this qualified improvement property. Two reasons on this would be related to, like, if the owner did some major improvements on a building that they owned, it was going to be 39 years. Now you have the opportunity to take it at the 15-year and then can take bonus on that 15-year property. So if you did a couple $100,000 or $1 million expansion of a building, or you bought a building, there could be opportunities, one, to qualify this property, or two, to do a cost segregation study that would create some losses as well that could help offset and generate some more cash into the business right now. All right, I did see on the list that there's probably some individuals that are attending as well. And so it's a couple of the individual requirements or provisions in there is that, supposedly there's checks that are supposed to be going out this week. They'd be going to taxpayers with the AGI up to 75 for single and 150 for joint. They phase out at like 200,000 for joint and 99 for single. And then, so you have the ability to get 2,400 with joint and then 500 per child. So it's, again, it's based off of your 2018 adjusted gross income. And if you filed in 18 and, you know, either got a refund and had direct deposit, they're most likely going to be able to just put that money into your account. So you should be on the lookout for that, or look at which account you had put it into to make sure that that you still have that account. They are doing some changes to retirement funds. You know, so if you had, if you took a distribution up to 100,000, they're going to waive the penalties, and the distribution itself would be paid over a 3-year period. So for example, if you were a business owner and were doing some large, maybe had a cash balance plan, or making big profit sharing distributions into your 401k, you now have the ability potentially to take $100,000 out. You don't pay the 10%, and then that 100,000 would be taxed over a 3-year period. And then for some of the people that are still running their business and over that required minimum distribution requirement, you do not have to take those required minimum distributions in the current year. The employer education payments, there is you know, some student loan payments made on behalf of employees are excluded from taxable income. The limit is $5,250. And then, you know, the big thing for both individuals and employers is that they're adding an additional $600 per week to the maximum state benefits available for up to 4 months. So this is also, as we get into the last couple things, one of the opportunities to kind of look at, you know, if your company has had it completely shut down, you may be able to take advantage of, you know, kind of temporarily laying them off for a period of time, getting this PPP, bringing them back, you know, hopefully doing some work during that period of time. The whole point of, in my opinion, the whole point of that PPP is that you're going to be able to hopefully bring them back and produce something during that time period. But with some of the state shelters in place and other stuff, if you're not a essential business, it may be difficult. So, you know, a lot of times the question is going to be, you know, do some of the employees make more money going on unemployment rather than staying on payroll? And you can temporarily lay them off still with paying their health benefits. So here's some additional resources, and then just some other ideas to consider. So one of the big things that we're seeing is a lot of our clients trying to do, you know, what we're thinking a 13-week cash flow or even longer, so that you kind of are understanding how this is really going to impact you. And I think it also allows you to think about, you know, what is the right size of your business. You know, I know that talent is a big thing for most CSIA members, but being able to do this and maybe using some data analytics or different things, you can see, you know, what is the right size of our business. I think there's some opportunities for some value priced acquisitions, right? So if you were in the process of looking at buying a company, it might still be a nice time to do it if depending on how big it is and how complex. There may be even an opportunity that you could do it through the SBA 7A program, and if you got it closed within 6 months of March 27th, you could get the first 6 months of those payments basically paid for by the SBA. So there is some opportunities there. I think there's some opportunities within estate and succession planning that we'll talk about briefly. And then here's some opportunities, right? We've talked about KPIs in the past, maybe using some data analytics to help with some of that stuff right now that you haven't had time to implement. This would be a good time that allows to, and really understands to look at your labor force to make sure that you don't have people in the wrong places.
So Tim, another question came in, and I don't think we've had this specifically, but the student loan payments that you just mentioned, being able to make those payments on behalf of the employee, would those be included in the calculation for the payroll forgiveness and calculating the loan value, or are those excluded?
I do not believe that those are included. But what it's saying here is if they are made, they are excluded from the taxable income of the employee. But that one, I'm not sure that they, I don't see it anywhere on any of the
yeah, I haven't seen it in any of the guidance either. So, and then just because we got about 10 minutes left, we don't have any other questions right now. But are there, in the upcoming slides, are there any sections you want me to go to? Thinking maybe the cash management one would probably be of the most value right now.
Yeah, I think we talked briefly about the 13-week cash flow, but I think maybe slide 25 might not be a bad one.
And
there's
been a few questions that I've responded to here, but these slides will all be available through CSIA. We'll send out the presentation.
Yeah. So, I mean, one of the things that we talked about the net operating losses to try to generate some additional cash. We talked about cost segregation studies already to generate additional cash. One of the planning opportunities that potentially is out there, and I don't know how many of the CSIA members, I know that a bunch of them, do sell projects internationally, could be shipped to Canada, could be shipped to Mexico or Europe. And there's a thing out there that some of our clients have already had, which was an IC disc. But because of the stock market dropping so much, potentially too, you could set up an IC disc, another one that would be owned by a Roth IRA. And the Roth would get funded with $5,000. It would put the money into the IC disc. But at the end of the year, you would calculate potential commissions that you would be able to charge the IC disc, which, for example, let's say you had $1 million of export sales, and on that you made $100,000 of gross profit. Well, you could charge the IC disc. The IC disc could charge the company $50,000, and so you'd send $50,000, and you'd be able to put that into a Roth IRA that would grow without any taxes in the future. And you potentially could give that to one of your kids or someone else to kind of transfer some wealth down the road. So I think that's one really interesting vehicle that the IC disc itself, because of it's a play on dividend rate, between dividend rate and ordinary income, and because ordinary income with the 199 deduction went down to about 29.6%, and dividend rate with the net investment tax went to 23.5%, there was only about a 5% arbitrage. So in this case, though, if you create a Roth, you don't ever have to pay any tax when it comes out, because there's no taxable event at that point in time. And then I guess, the only other thing, going back to the cash flow analysis, would be is really, again, thinking about, cash is king, right? And really understanding where you're going to be at. So what are the things that you should be doing? Is there, if you if you need cash, does it make any sense to try to, talk with your customers to get them to pay you an early pay discount? So you take you have them pay you right away, and you reduce your cash that you're getting. You were supposed to get a $100,000 payment, and instead you get a $95,000 payment. How does that work for your overall cash flow? And what you usually make in a year. So, maybe looking at speaking to your lender about modifying any of your current agreements, where you would get to be able to have extension on, let's say if you had borrowing base and it was 90 days, you move it to 180 days. Making sure that if you do have debt payments, maybe they can delay principal and interest. Any leases that you might have anywhere, could be on your high-low, could be on something else that you're trying to delay payments on some of that stuff. And then a lot of the states also have little programs that are going on. I know that Michigan has a $10,000 additional grant, depending on the size of the company, that you can apply for. So really just making sure that you're being aware of what's out there and trying to take advantage of all the different opportunities that you can.
So, Tim, another question came in here. Is interest paid on a traditional revolving line of credit also covered and forgiven on the PPP, or is it mortgage interest only?
Yeah, that's a good question, and I'm not sure I can answer that one. I mean, basically, it says it's on long-term interest payments, so I'm not sure that the interest paid on the line of credit will be, but it would seem like it should be in some ways, because you may be extended on your line of credit because of payments not coming in. So I think we'll get some more clarification on that. But you can definitely use it for that, right? But it may not be forgiven at this point.
Okay, and then another question, and I just put up Tim and Sarah, who's another one of the shareholders here, Clayton McKervey, put up their contact information. So if there's additional questions that we weren't able to get to that you members would like to reach out about, feel free to contact Tim or Sarah, and we'll try to help you out as best we can. Can you just go into a little more detail on the forgiveness clause? That was the question, is just a bit more clearly, but I guess maybe just kind of going through, how the forgiveness happens. We don't have a ton of information on that right now, but I guess any more information you can provide on that.
Yeah, I mean, the way that what they're talking about is, right, you got 2.5 times, the monthly payroll, right? So the half times is 25%. And that additional 25% is to be used most likely for, your rents, utilities, mortgage interest and other debt, debt interest that you had. It potentially can be used for payroll costs that are above, like if you ended up hiring more people or different things, you could use that payroll cost, but it can't be more than 25% of those other items. And if it is, then that portion, that difference won't be forgiven. And then when we do the calculation, it's going to be, again, based off, I try to use a simple example of, before 50 employees that you had, and now you only have 45, you take 45 divided by 50, and you get that's 90%. So 90% would potentially be forgiven. Hopefully that answered the question.
All right, that's all the questions I'm seeing right now.
Well, we hope that maybe it put a little more light on it. I know it's confusing. I think we're still confused. The banks are still confused. The payroll companies are still confused. So hopefully it will be much easier to understand here in the coming days. But feel free to reach out. We'd be happy to discuss anything.
Tim, one last one just came in here about the, can you repeat the portion about the 25%, what that applies to?
Yeah, so no more than 25% of the loan that you got. So if your average payroll was, let's just say, $50,000, you would get potentially $150,000. So 25% of that would be the 50,000. And therefore that 50,000, you could not spend more than that on payroll, rents, utilities, or I mean, not payroll, sorry, mortgage interest, rents, and utilities that you had.
All right. So Colin, I will turn it over to you then.
Yes, thank you guys. I have never seen this many questions come up. I think it's terrific. Great job, Tim. Great job, Brian. On behalf of CSIA, I would like to formally thank you both for this informative discussion, and I would like to thank all of those attending. We hope you found this webinar informational. CSIA would also like to take this opportunity to relay our desire for our association to please stay safe during this time. We thank you for coming together like this and using the community we have to strengthen each other. I think this is part of what makes this association so special. So thank you for being a part of it. And this concludes our program for today. Once again, thank you for joining us, and have a great afternoon, everybody. Thanks, Tim. Thanks, Brian.
Thank you.